The ETF market has come a long way from its days of pure passive tracking. One new innovation today is smart beta investing, which can combine the best of passive with some active selection. I'm Sarah Allen, and here today to talk with Livewire is Tom Wickenden from BetaShares. Tom, welcome.
Thanks, Sarah. Great to be here.
So to begin with, can you take us through what smart beta investing is and how's it different from other forms of index investing?
Yeah, of course. I mean, it's probably easiest to start with what is traditional index investing. So a traditional index will weight and select the companies by their size or their market capitalisation. So the bigger a company it is, the bigger weight it'll have in the index. Most of the index that investors are familiar with and that we quote on the news are these traditional indices like the S&P 500 and the ASX 200. And a lot of the early popularity in ETFs were in those traditional indices. Now, as indexing has evolved, so has what is available. And so now you can have indices that select and weight companies, not just based on size, but on other elements as well. And any index that does weight or select companies by something other than size would be classified as a smart beta index. So you can think about factors, you can think about equal weighting, even within fixed income there can be different elements like looking for potential future returns to select what securities you hold.
What are some examples in the market of smart beta investing?
Yeah, so some of the most common are factor smart beta products. So quality or quality indices, they would classify as a smart beta index. A lot of investors will be familiar with quality investing. Traditionally, a lot of active managers would target quality companies. You'd have a stock picker or a team of stock pickers go out and look for these fundamental characteristics. With a smart beta index, it follows the same methodology. It's just done in a passive manner or a rules-based manner. So for instance, high quality companies, they tend to have strong return on equity. They tend to have low levels of debt to equity and earning stability. And so what you can do is you can take a universe of companies and you can select just the top, let's say 300 companies based on those characteristics. And that would be a typical smart beta index. The same can be done for value investing, for growth investing, but they go beyond just factors as well. For instance, even an equally weighted index, where you take a universe of companies, and rather than weighting them by size, you just allocate them each the exact same weight. That's also an example of smart beta.
Why would investors choose to use smart beta over other forms of indexing?
So with a smart beta index, typically they're aiming to enhance returns or to reduce risk. So if we think about that quality example again, of course you can go out and buy an ETF that tracks the MSCI world, really broad, 1,500 companies. Using that quality example I used earlier, selecting the top 300 based on their earnings and their earning stability, you might be able to outperform the index, right? And we actually have an ETF at BetaShares, which is our Global Quality Leaders Index, which is ticker code QLTY. And that fund, that fund's index over the past 10 years has outperformed the MSCI world by about 3.5%. So performance can be one reason to use smart beta indices, but there are other reasons as well. With that equal weight example I mentioned, it might be for diversification. Traditional market cap weighted indices can become quite top heavy if a lot of the market is saturated in a few large names, like in the Australian market, our big banks and resources, or in the US market, large technology companies. So a smart beta index can be used in that instance to reduce risk.
What factors are gaining popularity at the moment, and why do you think that is?
So at the moment, over the shorter term period, we've actually seen size as a factor gain a lot of popularity. We've seen a number of years of, I think, mega cap outperformance in the US and also in Australia. And the higher interest rate environment actually, and particularly in the US, actually benefited a lot of those large cap technology companies. So as we move into Fed cutting and a lower interest rate environment, a lot of investors are thinking those companies that were impacted the most by rate hikes, those small and mid-cap companies, could now outperform. Outside of size, we always see high yield as a pretty popular factor here in Australia. Australian investors have a fairly healthy obsession with income and franked income. But I'd say by far the most popular factor would be quality, both globally and in Australia. Over the past 5 and 10 years, quality as a factor has performed really well. It's almost defied some fundamental market principles. You'd expect that these companies are high earners consistently, they might be priced really expensively. But over the past 5 and 10 years, their price performance and their earnings have continued to grow quite steadily. So it's a factor we think will continue to remain popular, both here and globally.
What are some of the risks that investors need to be aware of if they're using smart beta investing?
Yes, there definitely still are risks. I mean, the main one, and it's a fairly common disclaimer, but past performance isn't an indicator of future performance. If we're thinking about factors, factors, sure, there might be a history of the quality factor outperforming, as I've just touched on, but it doesn't necessarily mean it'll do so going forward. Using that same example, a quality index doesn't typically screen companies based on their valuations. So there might already be a lot in the price. So as an investor, you still need to understand, what is that fund holding? Why is it holding those companies? And what is it not looking at? And that's when investors can use their own, a bit of their own research. Also, it's very important to understand how each different smart beta fund actually selects companies. Because there could be two quality indices on the Australian market, but they might actually select companies in a slightly different manner. They might have different stock caps and different weights. So it's really handy for investors to go to providers' websites. For passive smart beta funds, you can go to the ETF's fund page. You can see the index methodology. How is that fund selecting the companies? You can see the top holdings as well, so you can get an idea of what the fund is holding. I'd say just finally as well, different factors tend to outperform at different periods along the market cycle. So you can't just always use a set and forget method of investing. There might be a period when value outperforms, when growth outperforms. So being aware of those periods as well.
Okay, we might now talk about some of the ETFs that use smart beta investing. So we might look at AQLT. What does this ETF offer investors, and how does it differ from using the broader index?
Yeah, great question. So AQLT, that's the BetaShares Australian Quality ETF. Now, if we think about the Australian market, we typically would talk about the ASX 200, right? Which is the 200 largest companies selected by their weight. AQLT uses quality screening to select and weight companies based on their profitability, their earnings stability, as well as their debt to equity levels or their leverage. It only holds around 40 companies, so it's a much smaller basket of companies in the broader market. Taking this approach in Australian equities has done really well. So the fund launched in April of 2022, and since then, on average, it's returned about 3.5% per annum above the market. So it can be a great way for Australian investors where our market is typically underweight quality as a factor to upweight to quality and try and seek higher returns.
Is there a bit of a myth to be busted around a perception that there's a lack of quality companies on the ASX?
I think it comes back to the fact that our market, if we look at the ASX 200, is a lower quality index because our largest companies are banks and our resources, which don't typically score too well when you look at quality characteristics. So the myth therefore is that you can't create a core portfolio of high quality Australian companies. We do have some great high quality companies. They tend to be mid and small cap names. What that means is if you use a standard quality index, yes, you can create a portfolio of high quality companies, but you'll also have quite a big tilt to small caps or to the small size factor. And so when it comes to the performance of that fund, it might be impacted just as much by quality as it is by size. So AQLT takes a bit more of a thoughtful approach. Understanding this shortcoming of quality investing in Australia, we still hold those, really high quality mid and small caps, but we actually in the portfolio also hold some Australian large caps as well. We reweight those companies by their quality attributes, and what you end up with is a core Australian portfolio. You've got really high exposure to quality as a factor, but your other factors are fairly balanced, fairly similar to the rest of the market. And so, this myth of not being able to invest in high quality companies in Australia, just takes a more thoughtful approach.
What are some of the names that people get exposure to through an ETF like this?
Yeah, so investors might be familiar with a few of the names, a few of the recent market darlings, names like WiseTech, which is a great software technology company working on supply chains. They've increased their earnings by about 15 times since listing in 2016. So, really strong and consistent earnings growth. Another example would be ResMed, which is a great healthcare technology name. Pro Medicus as well. They had earnings of around 37% last year, and they help hospitals with technology, visualization technology. There's also, some financial platforms like Hub24 and NetWealth. Really strong earnings, low levels of debt, so they make it into the portfolio as well. I think just finally, and this goes back to my point just before, you'll also see in the portfolio names like CBA and NAB, some of the bigger banks and big companies, and that's to, I guess, manage that size bias in a traditional quality index to make sure you still get high quality factor exposure, but not be skewed to small size.
Now let's turn to global options. We'll have a look at QUS. Why would investors choose an equal weight strategy?
Yeah, so an equally weighted strategy, QUS, which is our S&P 500 equal weight ETF, an equal weight strategy can be really handy in a number of different circumstances. Firstly, and probably most intuitively, to reduce the concentration in a portfolio. An equal weight ETF, very simply, gives an equal amount of weight to every company. If we think about the US market at the moment, you've got a scenario where the top 5 names in the US make up about 25% of the S&P 500. So there's naturally quite a lot of concentration there. An equal weight index will obviously give you much greater exposure across the whole subset of 500 companies in the S&P 500. So that's the first reason, reducing concentration, improving diversification. Another reason can just be outperformance. There are certain periods, short-term or longer-term periods, where an equal weight index has outperformed the broader market.
In what circumstances would this ETF outperform?
Yeah, so if we think first, I guess, shorter term, in the short term, equal weight indices tend to outperform when market concentration is high and subsiding, which might be fairly intuitive, but if we use an example from around 2020 to 2022, we saw the concentration of the top 5 names in the S&P 500 fall from around 20% to 15%. So just a 5% drop in concentration. The big tech names underperformed a bit. We saw some market breadth improve. Over that same period, the equal weight index, the S&P 500 equal weight, outperformed the market cap weight by 18%. So you can see for tactical positioning, that can be quite powerful for investors' portfolio. But also over the long run. Not just in the US, but in a lot of markets globally, equal weight strategies have tended to outperform market cap weighted strategies. The reason being, there's a few reasons. One is a tilt to the small size factor, which has tended to lead to some outperformance over time. There's also the natural rebalancing effect, whereby on each rebalance, since you're equally weighting the stocks again, you're selling your winners and you're buying recent underperformers, and this can have a good anti-momentum strategy. And then finally, just in terms of the skew of stock markets over time. You tend to hold a higher weight in more names in an equal weight index. You're very underweight a few names, but you're overweight a lot of names. And in stock markets, we know that often a few names perform really well, and most don't perform as well. So you often have a higher weight to those names.
You're rebalancing quite regularly in an equal weight strategy. How does that affect the tax implications compared to, say, a market cap weighted strategy?
So it can impact it a little bit, but the turnover is actually not too bad. I mean, you're still re-weighting the equal weight strategy just as often as the market cap weighted strategy. So with the S&P 500, that's re-weighted quarterly. And with the equal weight strategy, it's also re-weighted quarterly. To your point though, since you're buying and selling names to re-weight them equally, you often do realise some gains on the winners, but you also realise losses on the losers. So it can typically offset.
Can you bring it to life and share some examples of the differences between QUS and the S&P 500?
Yeah, of course. I mean, at the moment, as I mentioned earlier, the top 5 names in the S&P 500, you've got a 25% weight in those names. The bottom 400 companies in the S&P 500, you've also got 25% weight in them. So it's quite remarkable how much weight is in those top names and how much influence they're having over the broader market. We recently saw the correlation between the S&P 500 and the S&P 500 equal weight, which QUS aims to track, fall below 0.5, which is quite remarkable. It's the same 500 companies, just weighted differently. The reason for this is just the, idiosyncratic risks and the idiosyncratic impacts that those small number of companies are having on the entire indices portfolio. Another difference is just the average size of the index. I think it was 2 months ago, Berkshire Hathaway had the milestone of being like the 9th company ever to reach a $1 trillion market cap. The average market cap of the entire S&P 500 is actually that same number, $1 trillion. So even though 9 companies historically have only ever reached that mark, those large companies are so big in the index now, they've drawn the whole index weight up to close to $1 trillion. Whereas for the equal weight, it's closer to 100 billion, so it's much smaller. So you can see, even though it's the same companies, just that change in weighting can have such a big difference on the composition and the return profile of the indices.
Thank you so much for taking us through that today, Tom.
No worries, thanks Sarah.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.